Indian markets are at an all-time high despite a volley of bad news. COVID-19 remains a colossal threat with barely a tenth of our adult population fully vaccinated, which means a potential third wave may be inevitable. And that will lead once again to frequent lockdowns, to low personal incomes and consumption, job losses, unemployment. It's a perfect storm in which demand has eviscerated and national income is yet to recover to levels that were reached 2 years back. In other words, ordinary folk are suffering through an unprecedented economic vacuum. Inflation is high, and that's fueled by insane taxes on fuel. And of course, record commodity and food prices. And now, inflation is filtering through to manufactured goods as well. The government, of course, is borrowing insatiably, and that's throwing bond yields out of kilter. The central bank is trying every hook, every crook, and every tactic to hold them down, but the logic of markets is relentless. Interest rates will and must rise. America's Fed has already indicated it's ready to raise interest rates earlier than expected. That is, it could stop creating reckless money in what will be called taper tantrum 2.0. Now, all of this, high inflation, low demand, shrinking national income, high interest rates, a tapering Fed, all of this should be terrible news for Indian stocks, right? Yes, it's terrible, and yet they are at an all-time high. Why? While there are and always will be several complex intersections to explain sky-high stock markets, I would zero in on a few critical and core factors. You've heard it trotted out before as the principal reason, and it's true. A tidal wave of cheap money has been created in the West, especially in America. Now, that has inflated asset prices all across the world. Indian stock markets too have been buoyed by this unrelenting inflow of dollars, and that's shoved our foreign exchange reserves to well above 600 billion. But India is also host to a very unique and accelerating phenomenon that has played out invisibly but violently over the last 5 years. And that began with demonetization in 2016. And it was exacerbated by the launch of GST in 2017, finally becoming an inevitable outcome via the COVID-instigated digital revolution of 2020. These three forces have resulted in a massive formalization of India's economy as organized corporates have virtually swallowed the share of small, unorganized, informal sectors. Now, put another way, the footprint of the organized corporate sector has expanded in our national income, and that's creating extremely high profitability for bigger companies. Their market shares and product prices are rising, and wages and self-employed earnings are falling. Now ask yourself a truly simple elementary question. What is the stock market? Isn't it a sum of the market values of big companies? Often mistakenly, we believe that the stock market is a barometer of the whole economy. No, sir, that's not true. It simply captures and represents the value of a handful of very large companies, perhaps no more than 1,000 such entities in India. Now, these large companies could be posting an earnings growth of 40%. I'll say that again, 40% over last year. That's, of course, clearly growing at the expense of smaller players. So, it's a sine qua non that the indices which capture their value, the Sensex and Nifty, should be hitting all-time highs. Ironically, therefore, one of the reasons that the stock markets are high is because of the vicious pain inflicted on the rest of the economy. Finally, as our stock markets are hitting lifetime highs, the signs of froth, they are unmistakably emerging. When penny stocks begin to double every month, when the total market capitalization becomes much larger than the GDP at 115%, it's currently at a 13-year high. When people borrow crazily to invest in IPOs at, of obviously questionable valuations. For instance, fresh fundraising is now at a 14-year high. And we've still got a lot of the year to go. When after Zomato's spectacular debut, Paytm, another loss-making new age company, that one is looking to scoop up over $2 billion, making 2021 the highest ever IPO and fundraising year in India's history. When illiquid shares of unlisted companies, they are rising 20-30% in a month in the grey market, with punters hoping to cash out in anticipated IPOs. When people with long memories, they also forget what triggered the horrible crash of 2008 when markets melted by 75%. To refresh your memory, it was the IPO of Anil Ambani's Reliance Power. That got bids of over 8 lakh crore from gamblers for its utterly high-priced shares. Now, I'm not saying that these examples are directly comparable, but remember, Zomato got a demand of over 2 lakh crore rupees, which is the third highest ever. And if around Diwali, Paytm were to break Reliance Power's infamous record, well, you better watch this space very, very closely. You know what? Markets become truly frothy when the proverbial panwala begins to give you stock tips. Then you can be sure that the top and the end are near. The bulls and the gamers will tell you this time it's different. Believe me, it's never different. Because since time immemorial, markets have yo-yoed between deep fear and excessive greed. And they always top off when greed gets the better of sanity and judgment. We're almost there. Not yet at the end point, but pretty damn near it. So I reckon you now get it. These 3 reasons: the deluge of cheap global money, big companies becoming bigger, swallowing smaller players, and nearing the point of excessive greed. These three things best explain why the stock markets are at their highest point while the economy is at its lowest.